Crypto derivatives are no longer side bets in a corner of the market. Right now, they are becoming the bridge between crypto and Wall Street, and perpetual futures may be the clearest proof of that shift. That matters because the question in 2026 is no longer, should investors ignore derivatives? The real question is, which derivative structure actually helps you manage risk, express a view, or get exposure more efficiently? In the next few minutes, I'm going to compare crypto derivatives and traditional equity-style derivatives across 5 things that actually matter: accessibility, leverage, price discovery, risk control, and how fast each market is converging with the other. By the end, you'll know when crypto derivatives make sense, when they don't, and why perpetual futures are suddenly getting so much attention. Let's start with the biggest difference, where each market came from. Traditional derivatives were built for stocks, indices, commodities, and rates. They're familiar, heavily used, and embedded in the global financial system. Crypto derivatives, by contrast, started as a niche instrument inside a digital native market, but that niche has been shrinking fast. According to CoinDesk, crypto and traditional finance are converging rapidly, and perpetual futures are at the center of that shift. That is not a small detail. It means the old line between crypto trading and professional derivatives trading is getting harder to draw. So, on the first criterion, accessibility, who wins? If you want the broadest institutional familiarity, traditional derivatives still win. They're the older, more established tool. But if you want the most direct way to express a view on digital assets, crypto derivatives are winning right now because they are built around the asset class people actually want exposure to. That's why perpetual futures matter so much. They're becoming the strongest bridge between crypto and traditional finance. Let's talk about leverage, because this is where excitement turns into danger fast. Both traditional derivatives and crypto derivatives can amplify gains and losses. That is true in both worlds. But crypto derivatives often attract traders because they offer a more direct, faster-moving exposure to volatile assets. In plain English, if the underlying market is moving hard, derivatives can make the move feel bigger, faster, and more unforgiving. That can be useful if you know exactly what you're doing. It can also be brutal if you don't. Traditional derivatives generally come with a longer history of usage, more familiar risk frameworks, and a market structure many investors already understand. Crypto derivatives, especially perpetual futures, are newer in mainstream investing terms, and that means the learning curve can be steeper. The tools are powerful, but powerful tools punish sloppy use. So, on leverage, the winner depends on your goal. If you want something more standard and easier to contextualize within a traditional portfolio, traditional derivatives are safer from a familiarity standpoint. If you want a direct, flexible way to trade crypto price moves, crypto derivatives win on pure usefulness. But usefulness is not the same as safety. Now let's move to price discovery, because this is where derivatives stop being just a trading tool and start becoming a market signal. In mature markets, derivatives often help tell us what traders expect next. They can shape sentiment, hedge risk, and reveal how much demand there is for exposure. Crypto derivatives are increasingly doing that for digital assets. And as they converge with Wall Street, they may do it for more than just crypto. CoinDesk's reporting points to equity perps, potentially proving the convergence even further. That phrase matters. Equity perps could soon be a real test of how far the crypto-style perpetual futures model can spread into traditional markets. If that happens, the market structure conversation changes completely. It would mean a product that once lived in crypto-native venues is influencing how traders think about equities too. That's a huge signal that crypto derivatives are not just following Wall Street anymore. They're starting to influence it. But let's be honest. If you are a long-term investor, price discovery is only helpful if it improves your decisions. Otherwise, it just becomes noise. And in 2026, there's plenty of noise. That brings us to the fourth criterion: risk control. Traditional derivatives are often used for hedging, managing exposure, and reducing portfolio risk. Investors know this playbook. A fund can hedge equity exposure. A business can lock in pricing. A trader can define risk around the position more precisely than with spot assets alone. Crypto derivatives can do that too. In fact, they are increasingly attractive because they allow investors to manage digital asset exposure without always needing to hold the underlying coin directly. That can be useful for institutions, active traders, and anyone trying to avoid the operational headaches of custody. But the risk profile is different. Crypto markets can move quickly, and derivatives can magnify that speed. So, while the instrument can improve risk control, it can also introduce liquidation risk, margin pressure, and execution risk if you're overextended. Here's the practical takeaway. If you are using derivatives to hedge, keep the position size smaller than your ego wants. The market does not care how confident you feel. And there's one more layer investors need to understand: convergence. CoinDesk, crypto, and traditional finance are converging fast. That sounds broad, but in practice, it means the walls between asset classes are thinning. Perpetual futures are a strong example because they combine the flexibility crypto traders, like with the structured derivatives users, already understand. That makes them a kind of common language between two markets that used to speak different dialects. If you are a global investor in 2026, that convergence matters whether you trade from New York, London, Singapore, Mumbai, or anywhere in between. Why? Because product design shapes access. If crypto derivatives become more standardized and more connected to traditional market behavior, then more investors will be able to use them, compare them, and potentially regulate them more consistently. But here's the tension. More conversions can mean more legitimacy, but it can also mean more competition, more complexity, and faster transmission of shocks between markets. In other words, when crypto derivatives become more Wall Street-like, they may also inherit some of Wall Street-like. They may also inherit some of its systemic impact. So which wins, crypto derivatives or traditional derivatives? For familiarity, broad acceptance, and established risk frameworks, traditional derivatives still win. For direct exposure to digital assets, fast-moving market expression, and the emerging bridge between crypto and traditional finance, crypto derivatives win. And for investors trying to understand where the market is heading in 2026, the more important winner is perpetual futures. They are the clearest symbol of the convergence CoinDesk keeps talking about. Once a niche crypto instrument, perps are now at the center of a much bigger conversation about how modern markets are being built. So what should you actually do with this information? First, if you are a long-term investor, don't confuse market innovation with a mandate to trade it. You do not need to use derivatives just because they are getting influence. Second, if you do use them, treat them as tools, not bets. Know your leverage, know your exit, and know exactly why you're using the position. Third, pay attention to perpetual futures because they are no longer just a crypto curiosity. They are one of the clearest signs that crypto and traditional finance are merging in real time. The investors who benefit most in 2026 will not be the ones chasing every new product. They'll be the ones who understand which tools improve their edge and which ones just increase their risk. Crypto derivatives are rising in influence because they sit at the intersection of speed, flexibility, and market convergence. Traditional derivatives still have the trust and structure, but crypto derivatives are pushing the frontier. Use the right tool for the right job and never confuse complexity with advantage. If this breakdown helped, subscribe so you don't miss what's coming next, and drop a comment with the one thing you're watching most closely in derivatives right now. The smartest move is usually the simplest one. Understand the instrument before you touch the leverage. This is general financial information, not personal investment advice. Always do your own research and consider speaking with a qualified financial professional before making investment decisions.